There are three ways to treat subsequent events or events that occur after the reporting period. The first is to adjust current financial statements with the event. The second is to disclose the event in the current financial statements without making an adjustment. And the third is to not do anything at all. We can use a simplified decision tree to help determine the correct treatment of subsequent events. The first question that needs to be considered is, does the subsequent event provide additional information about an event or condition that existed at the reporting date? If the answer is yes, then it is considered to be an adjusting event. That is, IAS 10 paragraph 8 requires an adjustment to profit and losses and other comprehensive income and assets and liabilities. Consider inventory that cost $10,000 at year end and which was sold for $9,000 in the beginning of the new financial year. Using the decision tree, we can see that the event of selling the inventory for $9,000 after year end relates to valuation of inventory that existed during the financial period. Thus, this is an adjusting event. IAS 2 requires inventory to be valued at the lower of cost or net realizable value. So the inventory of $10,000 would need to be adjusted down to its net realizable value of $9,000 at year end. Profit and losses would also be adjusted with the impairment of $1,000. Now let's consider an event that is new and does not relate to or provide additional information or evidence of pre-existing conditions. These types of events are considered non-adjusting. As the name suggests, no adjustments are permitted for these events. However, we need to consider how to treat them. We have to consider an additional question, that is the non-adjusting event material? An event is considered material if it has the ability to affect users' decision-making. If the non-adjusting event is not material, then no further action is required. If the adjusting event or non-adjusting event is material, then details of the event needs to be disclosed in the notes to the financial statements. Consider a tractor worth $100,000 at year end. At the beginning of the new year, a tornado destroyed the tractor. Using the decision tree, we know that the tornado occurred after year end. Even though it relates to a tractor that existed at year end, it does not change the valuation of the tractor as at year end date. Thus, the effects of the tornado is a non-adjusting event. The effects, however, are material as it would affect the decision-making of users. Thus, the event needs to be disclosed in the notes. That is, the nature of the event and the estimated financial effect needs to be disclosed. To recap, there are three possible ways to treat an event that occurs after the reporting period. You can use the simplified decision tree to consider the relevant questions and arrive at the correct treatment.